Hi, I'm Rhonda Thrower. We're going to talk about some terms in Chapter 18. So if you'll bear with me just a second until I can get the screen pulled up for you. I have made an Excel spreadsheet for you that has some Chapter 18 terms on it. And so I want to talk to you about these terms. In this course, we will be talking about managerial accounting. So it's important for you to know the definition of managerial accounting and how it's different from financial accounting. But basically, managerial accounting, we're going to account for information that is used just to meet management's needs for the company. We want to try to help management to make good decisions so that they can run the company successfully. And so that's the purpose of managerial accounting reports. They're going to be used basically just to meet the needs of management. Some examples of managerial accounting reports might be a report that we would prepare for a specific department's wages, such as Department A wages. We might need to prepare a report for that. We might want to prepare a sales report for our company's management so that they can see how well we have done for a period of time. We might want to prepare an inventory report. A managerial accounting report is anything that management asks us to prepare that would be considered a managerial accounting report. So things like budgets, those are managerial accounting reports, and we'll be talking more about those as we go through this particular course. All managerial accounting reports have certain characteristics associated with them. First of all, the reports are prepared for internal users of accounting information. Those internal users would be management or maybe the employees that are working for the company. They might be interested in managerial accounting reports. The accounting reports for managerial accounting are going to be prepared for the external users of the accounting information, which will be management and, excuse me, I said external, but I meant internal. They will be prepared for internal users of accounting information, such as management and employees. All managerial accounts, accounting reports are going to have both objective information in them as well as subjective information. And what objective information means that the information that we prepare for the managerial accounting reports are going to contain hard facts associated with them. But managerial accounting reports not only have to contain some hard facts, they also will contain estimated data. And so that's what we mean by subjective data. So managerial accounting reports are both objective and subjective. Objective meaning the data is going to be based on hard facts that have actually happened. And then some managerial accounting reports are based on subjective information, which may contain estimated data. So things like in managerial accounting, we're going to be looking somewhat at financial statements so that management can make good decisions about the company based on financial statements. Financial statements have to be objective. They have to be based on reliable evidence, things that have actually happened to the company, and they're based on hard facts. But managerial reports can also be reports that contain subjective information. For example, a report that we use internally that management would be interested in is budgets that we would prepare for maybe our sales or our production types of budgets. But these budgets contain estimated data in them. So managerial reports can contain both objective and subjective information. Managerial accounting reports are prepared at fixed intervals at the end of the time period for these reports, and the reports are also reported on a as-needed basis. So management could come in any day and say, could you run me a report for how many hours we've used in Department A? And you would be responsible for doing that if you were a managerial accountant. So you don't always wait till the end of the period to prepare managerial accounting reports. But some of the reports, such as financial statements that management is interested in, would take into consideration that they have to be done for a period of time. You'll remember in Accounting 1, when we discussed financial statements, we said that the income statement would be prepared for an accounting period, which could be accounting period could be on a monthly basis, could be on a quarterly basis, or it could be on an annual basis. But managerial accounting reports are prepared sometimes at the end of the accounting period, but they can also be prepared anytime that management needs them on an as-needed basis. Also, managerial accounting reports are going to be prepared for the company as a whole. Like the financial statements would be prepared for the company as a whole, or we might have segment reports for companies that have different segments that they are reporting information for. So the reports can be for segments of a company too. They don't have to be just for the whole company. They can be for a particular department, a particular product. They could be prepared for different segments of a company. Financial accounting information is reported in our financial statements. You've already learned a lot about preparing financial statements in Accounting 120, but as a review, the financial statements for a corporation are going to be your income statement, your statement of retained earnings, your balance sheet, and your statement of cash flows. Now, these are corporate financial statements that I'm talking about here, that I've got pointed out here. If you're not familiar with corporate financial statements, the only difference between those and the proprietorship statements is basically in a proprietorship statement, we'd have a statement of owner's equity and not a statement of retained earnings. The retained earnings statement is for a corporate form of business. And the corporate form of business is discussed in ACC 122 that's offered in the summertime. So some of you may have taken ACC 122, some of you may not have taken it. If you have taken ACC 122, you are familiar with these types of financial statements. If you have not, you're familiar with proprietorship statements, which just means basically that we still have an income statement. The income statement would show us our profit for a period of time. The income statement for a proprietorship and a corporation are basically the same. You're going to report revenues and expenses on your income statement, as well as gains and losses. All of those would be on the income statement itself. The statement of retained earnings would be used for a corporate form of business. It's similar to the statement of owner's equity. In a proprietorship, we would fill out the statement of owner's equity, and that would show the owner's worth in the company. In a statement of retained earnings, it's going to be similar to a statement of owner's equity in that we're going to keep track of retained earnings in a corporate form of business, and we're going to add to it any net income and subtract out any dividends to determine the ending amount of the retained earnings. Don't worry too much about preparing the statement of retained earnings. We'll get to that either in a later course or we'll talk more about it at some other time. But for right now, you should be familiar with an income statement where we were going to record revenues and expenses for a period of time. You should be familiar with the balance sheet, which will have all of our assets, our liabilities, and our owner's equity recorded on it. If it's a sole proprietorship form of a balance sheet that we're talking about, the owner's equity section is called owner's equity. If it's the corporate form of a balance sheet that we're talking about, the owner's equity section is called shareholders equity or stockholders equity, because if you're in a corporation, the owners of your corporation are going to be the investors in your corporation, whereas the owners of the sole proprietorship would be a one owner type of business. That's what a sole proprietorship is, and the balance sheet would state that there's only one owner's equity, and that would be reported on the balance sheet. If we are reporting for a partnership form of business, which also is discussed in ACC 122 in the summer, the balance sheet owner's equity would consist of two separate owner's equity accounts or more, depending on how many partners a partnership would have. So every partner has their own owner's equity, and so in a balance sheet for a partnership form of business under owner's equity, we would have all of the partners' capital balances listed separately. And then there's the statement of cash flows that was discussed briefly in Chapter 1 in ACC 120. And this is just going to show you how our cash is brought into the company versus how it is spent. These are examples of financial statements. In financial accounting, we learned how to prepare financial statements. And the financial statements have to have certain characteristics associated with them too. The first characteristic that I mentioned here is that the reports are going to be used by external users. External users are people outside of the company who would be interested in the accounting information for the business, such as investors or creditors. Financial statements are also prepared for internal users for management purposes. So financial statements or financial accounting somewhat overlaps managerial accounting, because in managerial accounting, we're preparing all the reports that management wants us to prepare on an as-needed basis, but we're also preparing financial statements in managerial accounting. Getting back to our financial statements based on financial accounting, the financial statements are based only on hard facts. The information in the income statement has to be relevant information about the data and the period of time that you're recording that information for, and it has to have actually happened for it to go into the income statement. or the statement of owner's equity, or the balance sheet, or the statement of cash flows. It's based only on relevant information that actually happened. That's what our financial statements are made up of. And financial statements are prepared only at the end of the accounting period. So you remember the time periods for accounting could be on a monthly basis. An income statement would be prepared from the beginning of the month to the end of the month. Or an income statement could be prepared on a quarterly basis from the beginning of the quarter to the end of the quarter. Or it could be prepared on an annual basis from the beginning of the year to the end of the year. But these financial reports, financial statements are always prepared at fixed intervals at the end of the accounting period. And financial statements are going to be prepared for the company as a whole. We usually don't prepare an income statement for a segment or a part of a business, but we're preparing it for the whole entire business. Another term that you're going to run into in this chapter is what we call a line department. A line department means basically that employees that are involved in a company that are directly involved in producing a product or revenue will be considered the line department. A staff department, on the other side of that, is one that will provide services and assistance to the line department. The staff department can also provide other staff members support to the management process too. So these are two terms that are introduced to you in Chapter 18. In managerial accounting, we're preparing management reports. And so the management process is something that they have introduced to you also in this chapter. And part of the management process is to be able to plan for your company's operations. And a management team will do that with strategic planning, which is long-range plans for operations of the company from 5 to 10 years, or they can do short-term plans, which are called operational planning, which would be less than 5 years. But a part of the management process is going to be that management is going to plan for the operations of the company. So they're going to set strategic plans and also operational plans so that they can measure and look at these plans to see how well they did at the end of the accounting period. This would be a process called control. Management wants to have control over the company, and so a part of controlling the company is to set goals for the company through planning procedures and then seeing if those goals have actually been met. Another part of management process is improving the products or the services. Management is responsible for the products or the services that are provided to the customers. So you want to make sure that there's continuous improvement in those products and customer relations or the services that we are performing for the customer. And so management is responsible for improving the products and the services for the company. And of course, they are also responsible for decision making. That's a part of the management process. Another term that is mentioned in this chapter is the controller. And the controller is going to be the chief management accountant. So this is the accountant who's going to be responsible for preparing reports that are inside of the company. They would be responsible for preparing budgets. They would be responsible for looking at ledger accounts and making sure that data is recorded properly. But the controller is what we call the chief management accountant. That's the one who is overall the other types of accountants within a company. So if you go to work for a company and you're responsible for preparing the financial statements, you could be possibly called a controller of that company, but you are the chief management accountant. And so you are responsible for the managerial accounting reports for the company. Another term that you have to become familiar with in managerial accounting is the term cost. And sometimes we refer to cost as expenses, but cost is basically cash that we're going to have to pay out, or some type of non-cash assets that we're going to exchange as a sacrifice for the goods that we are producing. Or our services that we are providing in producing revenue. So a cost basically can be anything that costs us cash that we have to sacrifice for the products or the services of the company while we're producing revenue. A cost object is an important term that we are going to be talking about a whole lot in managerial accounting. And a cost object is anything that you want to assign a cost to would be a cost object. For example, a lot of times we want to assign cost to the products that we're manufacturing, or the services that we are rendering for a customer. Products or services can be a cost object. Our actual customers, their sales can be a cost object. A department could be a cost object. We might be interested in knowing what all the cost of a particular department are, and that department would be considered the cost object. It's anything that you want to assign a cost to is going to be a cost object. And we could also assign cost to certain activities, such as setting up machinery or setting up procedures to produce the product. We could set up a cost object for moving our materials from one place to another. That's a type of activity that could become a cost object. So again, a cost object is really anything you want to assign a cost to. In most of the problems that we're going to be doing in this course, we're going to be assigning cost to our products. And so we're going to be talking a whole lot about a manufacturing type of business in this course. And so we're going to be assigning cost to our products, and the product can be a type of cost object. Now, when we assign cost to a product or any cost object, they can be broken down into two types. They're what we refer to as direct cost, which are the costs that we can trace specifically to the cost object. If the cost object is a product, some direct costs that we should be able to trace specifically to the product will be something that we refer to as direct materials. Direct materials are tangible or touchable materials that can be traced to the cost object. Usually we can trace those to the cost object by physical observation. So in this chapter, we're going to be talking about producing guitars for a manufacturing company. Their product is going to be guitars, and we are going to be producing wooden guitars. So the wood that we could trace to the product, the guitar, is a type of direct materials. because they can be seen in the finished product, which is the guitar. They can be traced by physical observation. We can see those. We can trace them to the product itself. They are tangible materials. We can see them. They go into the finished product. And these direct materials, in order for them to be considered to be direct, must also be a significant portion of the total cost of the product. So if we have insignificant cost, we treat those as what we refer to as factory overhead. We'll talk about that in just a moment. But direct materials are an example of a direct cost. A direct cost or cost that we can actually trace to the cost object through physical observation, and they are usually costs that are a significant portion, a material portion of the total cost of the product. That's what we call direct materials. Another cost that you need to become familiar with is what we call direct labor. It too is a direct cost and can be traced to the cost object. The direct labor is the labor that's paid to the people who are working on the cost object. And this labor can be traced directly to the product. It's usually the people who are actually physically working on the product itself. So if we are manufacturing guitars, we're going to have to pay someone to cut the wood out that becomes a part of that guitar. The cutting process of the wood would be considered to be direct labor, and most likely will be a significant portion of the total cost of the product. So in order for it to be a direct cost, such as direct materials and direct labor, it really needs to have a significant effect on the total cost of the product. And they both have to be traceable to the product itself, which is the cost object, or which will be the cost object in most of the cases that we will be working with. Now, there may be a few cases where we work with services rather than products, but there's also, with services, there are materials that we're going to keep up with and labor that we're going to keep up with, but there probably isn't going to be a whole lot of factory overhead associated with those services. But direct materials and direct labor are direct cost. Let's start with a manufacturing business that's going to manufacture a product. And so these could be traced to the cost objects, which are the products itself for a manufacturing business. The indirect costs are costs that we can't specifically trace to the product itself. And the best definition of factory overhead cost are all costs other than direct materials and direct labor. We already have talked about the fact that direct materials and direct labor are direct costs, but factory overhead costs are indirect cost. So all costs other than direct materials and direct labor that the factory incurs are called factory overhead costs. Here are some examples of factory overhead cost. Indirect materials will be considered factory overhead. Now, sometimes indirect materials can be traced to a product, but usually indirect materials have such insignificant value associated with them that we don't want to count for them as direct materials. We just throw them in the category of factory overhead, and then we will allocate these costs in factory overhead over time, which we'll be discussing later on within either this chapter or the next chapter. So some examples of factory overhead are indirect materials. And indirect materials are the materials that we need to use to produce the product, but they are not a significant portion of the product, and they have insignificant cost associated with them. Indirect labor is also considered to be factory overhead. Your indirect labor is the labor that you would pay to people who are not working on the product itself and trying to convert the materials in the product to a finished goods. Indirect labor would be the labor that we would pay, for an example, to maintain the factory building. Perhaps we have some people who are maintenance types of employees. They're going to be maintaining our building. Their labor is considered to be indirect labor and will become a part of your factory overhead. Factory overhead cost can be any cost that's associated with the factory other than direct materials and direct labor. So if we have something like factory insurance expense, factory supplies, those are types of factory overhead costs. Factory overhead costs are going to be allocated or applied to something that we call work in process, which we're going to be discussing probably more in another video that I have planned for you. But basically, work in process is where we've started converting materials, but they're just not through yet. There's an inventory account that we'll keep up with called work in process. And work in process will be allocated to factory overhead. And they will do that using a predetermined factory overhead rate that I'll show to you later on in this semester. Now, product cost is the same thing as manufacturing costs. Sometimes in the textbook, they'll ask you for manufacturing costs. Sometimes they'll refer to it as product cost. But product costs are going to be the cost of your materials, your direct materials, your raw materials, as sometimes they're called, the direct labor, and the factory overhead. They're all the costs that will go into the product. So we have direct costs, such as direct materials and direct labor, and then we have indirect costs, such as factory overhead, that become a part of the product cost. So our manufacturing cost or our product cost are going to be your materials, your labor, and your overhead. Period costs are what we refer to as selling and administrative expenses. They are non-manufacturing costs. So in one of the problems that you're going to have to do, you're going to have to decide what is a product cost and what is a period cost, and how it affects the product cost or whether it affects the period cost. In other words, they're going to ask you what manufacturing costs are and what some non-manufacturing costs are. But you also have to be familiar with what period costs are. And period costs are just your selling and your administrative expenses. They're your operating expenses for your company. They are considered to be non-manufacturing costs. Your selling expenses, you might remember from ACC 120, your selling expenses are expenses that are incurred in the marketing or the selling of the product and delivering that product to the customer. So things like advertising expense, delivery expense, sales salary expenses, Those are going to be selling types of expenses and are considered to be period cost. Administrative expenses are the operating expenses that are incurred for managing the company, and they're not really related to the manufacturing or the selling functions. So if you're paying your controller a salary, most likely that will be a type of administrative expense. Your salaries of your office workers would be administrative types of expenses. Your office supplies are administrative expenses. These are things that would go in the administrative expense category, and they're not related to the manufacturing or the selling functions of expenses for a company. Another term that you need to become familiar with are what we call prime cost. Your prime costs are the sum total of the direct materials cost and the direct labor cost. The two of those together are what we refer to as prime cost. Conversion costs are going to be the sum of the direct labor and the factory overhead. These are considered to be conversion cost. So all of these are some cost terms that you need to become familiar with in Chapter 18. And I'm going to stop here for today because I feel like I've given you plenty of terms to look over, but make sure you look over these and the definitions to these. I will post these terms with your videos and your assignments for Chapter 18 under Throwers videos. So I'll see you again the next time. I'm going to stop sharing this with you, and we'll see you again. Bye-bye.